The market has been doing well. The headline says stocks are up. The S&P 500 keeps hitting new heights. But here is the uncomfortable truth. Most investors still underperform, even in good markets. Not because the market failed them, but because of how they invest. In this video, I will show you why this happens, the data behind it, and how long-term investors quietly sabotage their own returns without even realizing it. When we say underperform, we are not talking about losing money. We are talking about earning less than the market itself. For example, if the S&P 500 returns about 10% a year long term, many investors earn 6%, 5%, sometimes even less. That gap doesn't look big, but over 20 or 30 years, it becomes hundreds of thousands of dollars. According to the long-term studies in the US, including data from Dover, the average equity investors consistently earn several percentage points less than the market. And this happens even during strong bull markets. So the question isn't, is the market good or bad? The real question is, why do investors fall behind when the market is doing its job? The answer isn't intelligence, it isn't income, and it isn't access to information. The biggest reason investors underperform is timing. People buy after market have already gone up, and they sell after market have already fallen. Not because they are foolish, but because they are human. In good markets, optimism rises. People feel confident after gains have already happened. Then, when markets fall, even temporarily, fear takes over. Think about 2008 crisis. Millions of investors sold near the bottom. Then many stayed out during the recovery. The same pattern happened in 2020 and again during inflation fears in 2022. The market recovery, but many investors didn't because they were not fully invested anymore. Another reason investors underperform in good markets is overactivity. The more often people trade, the more they miss long-term compounding, pay taxes, pay fees, make emotional mistakes. Not because those investors were smarter, but because they interfered less. In good markets, many investors stayed overly cautious. They hold large amounts of cash, waiting for the right time, the next crash, more certainty. But inflation quietly erodes that cash every year. Investors also chase what just happened well. Last year's best fund, last year's best sector, last year's hot idea. But by the time most people buy in, the advantage is already gone. The market rewards patience, but human psychology rewards action. Doing nothing feels wrong, even when it's the right move. So investors change strategies, adjust portfolios, react to news, and slowly drift away from long-term success. Here's how long-term investors can avoid underperforming, even in good markets. The market doesn't punish investors for being wrong, it punishes them for being impatient. Most investors don't underperform because the market fell. They underperform because they get in their own way. If this video felt uncomfortable or familiar, you are not alone. Long-term investing isn't about doing more. It's about doing less, better. Thanks for watching.